Hello and welcome to Hands on AI, where we navigate AI adoption in financial services. I'm Max Eber, co-founder and CPTO of Taktile. Today, I talk to Baishi Wu, Director of Product Management at Chime. Baishi has almost a decade's experience in consumer finance, and as a product leader at Chime, he's behind some of the most innovative credit products in the market today. Since Chime's success stems from serving audiences who typically wouldn't have access to credit, Baishi offers a masterclass in how to align product and risk to create a sustainable business model. We talked about how the definition of product market fit shifts in the context of credit products, how Chime's primary account relationship with customers is critical to their underwriting success, and what Baishi anticipates next for AI and financial services. So let's get into it. Cool. So, Chime is a very interesting use case for thinking about how risk and product interact because the mission is to unblock financial progress for everyone.
Mhm.
So how does that impact how you think about product market fit and balancing adoption with risk?
Yeah, it's a tough challenge. I would say that typically when you think about product market fit in fintech, it's just like how many people are in the funnel and how many people are using the product. But when it comes to credit products, you don't really tend to have that challenge. People see $100 and they tend to want $100, and the question is whether or not that you as the lender will actually get paid back. And so that's the real challenge of product market fit, which is not how many people use the product, but how many people will actually repay the product. And it goes into what you talk about with what Chime wants to do, which is, we want to cultivate a long-term relationship. And that happens not when you actually give somebody, access to liquidity, but actually when they repay it and what they do on the platform on the meantime.
So this is a story that I often hear, which is marketing tends to attract the really cheap leads, but then risk will reject those because those are exactly the ones that are cheap to acquire, but the ones that won't work just economically for the company. So how do you make that work then? How do you sync up marketing with the risk side of the house and the product side of the house?
I think theoretically, there's an idea that should span this already, which is the idea of lifetime value. And that's the same way that Chime approaches everything. I just think that typically in a company, you want to believe in one version of lifetime value and another function wants to see the other version. And so I think the whole goal of trying to make marketing and risk work together is just aligning on what that lifetime value is and capturing the actual repayment on the liquidity side within that. And so if you can do that, you can basically produce higher quality leads. You can get people who actually pay you back over time. And that's how you create a sustainable relationship versus something where, you get people in the door, but then they turn right out.
Can you speak a bit about the evolution of that? I'm sure you didn't fully figure this out on day one, and that has evolved over time and gotten better. So what were the big steps in that evolution to really finesse that channel?
Yeah, I'd say Chime is a pretty deliberate company overall. And especially when it comes to offering our members liquidity. We've done a lot from, being very, very deliberate in terms of how much liquidity we give, how we see somebody repay, and have a long period of making sure that we test something that has the right product market fit over time so that when we roll it out in a wide way, we don't all of a sudden lose our shirts. And so our focus here is like, how can we actually underwrite someone better in the beginning? And then more importantly, actually figure out, is there a mechanic that we can use and leverage Chime's primary account relationship so that they ultimately are able to demonstrate an ability to pay us back over time? And I think that's the main thing that is kind of differentiated. And so, when we've approached this, it's all about, okay, what are the signals that you can see in the beginning, but more importantly, like what are the things that you can kind of optimize once you have that primary account relationship over time that ensures that you have every right to get repaid over time.
I would love to dig into sort of the underwriting strategy in particular to the extent that you can share it. So on the initial underwriting side, how did that evolve over time? And what do you think are things you did particularly well at Chime? Or what are you proud of?
So Chime's entire strategy from a banking perspective is trying to cultivate this primary account relationship with the idea that if you can use Chime for everything, you move your deposit over, you all of a sudden get paid 2 days early, you can benefit from fee-free overdraft. All of that is really like a flywheel that really benefits how effective Chime can be from an underwriting perspective. You think about like how much more information you'd know if 100% of your cash flow came in one place versus a small portion. And I think the ability to do that continuously is also one of the unlocks of what does make Chime special. I think the difference between, what you look at from a bureau, it's a single point in time and have a full history versus cash flow, which you can kind of constantly look at and it's constantly evolving. And as long as you are continuing to be the source of that cash flow, you actually have the ability to continue to underwrite more effectively than everyone else. So I think that's step one. I think if you can create the primary account relationship, you have a stronger advantage of actually benefiting from that. And so that's underwriting. And I think the next piece of that is actually seeing if you can actually make that happen on the repayment side too.
So if you're, say, a typical fintech that is not a primary account for most people, but a secondary account, and then you use open banking to get the primary account data. What is the difference? What is fundamentally the secret sauce or the big unlock that you have from being the primary account? What is
Yeah,
different in those two things?
I would say there's two things. One is that, when people have traditionally looked at this from an open banking perspective, they took the analog of how people use credit data and try to apply it for cash flow data. And it's like, okay, we'll look at a single point in time. Maybe we'll see some historical transactions. But we'll try to underwrite you on the spot. And I think that's particularly challenging because the nature of cash flow data is it's just more dynamic. It doesn't really have the same history as everything else. You see what you see, but you can see it in real time. And so I think the key aspect of what you want to do on the cash flow data is just to see it as many times as you can and influence your decisions, on a continual basis and adjust what you have to do. So that's the first piece. The second piece is really just on the repayment side, like I mentioned. If you actually have the primary account relationship, you have a better insight in terms of when the cash flows happen, and you can cultivate different strategies around how somebody's actually going to repay you. You don't rely on trying to have a connection with a third party and hopefully pulling the money and hoping that it's there. You have really good insight in terms of when that money arrives because you know when their next direct deposit is coming, and you can do a lot of things where you kind of adjust the repayment schedule or really make it so that the repayment schedule matches the needs of the member, in terms of like making sure that Chime works and has a schedule based on when somebody else gets paid. And that I think is another key to making sure that this stuff actually works over time.
So one thing in these sort of permanent models of credit where you don't do a single loan one-off, but you really think of this as repeat lending or maybe even a credit line, which is obviously the ultimate version of repeat lending. How do you think about the dynamics of this? So the ladder, the graduation path of the customer. And one thing I'd be particularly interested in is how do you know yours is good? Because these things are much harder to test and to roll out. You can't just A/B test a ladder that runs for 2 years and know it's a great ladder. So would love to understand like what do these strategies look like roughly, and then how do you iterate on them and how do you make sure that your thing works?
I think it's the same flywheel that I mentioned, where a lot of what you're trying to value is whether or not somebody has demonstrated kind of the repeat willingness to pay in earlier versions of the product that you've given, and whether or not that qualifies them for what comes next. And so Chime thinks about this in a very similar way, where we have different liquidity products for different situations, and more importantly, different amounts of liquidity that we can offer you. So it can start with something as low as like a $20 fee-free overdraft, where look, if you can demonstrate an ability to make sure that that amount is at risk, we can increase your overdraft limits over time, or we can make sure that all of a sudden we can give you something more like MyPay, which gives more control over how you use it. And if that works, we can give you a loan, which gives you more flexibility to repay, have something that you can repay over time. You know, all of these things that increase our exposure, but only makes sense if you could demonstrate that consistent ability to do so. And throughout this entire time, rather than us being kind of another lender where you demonstrated this ability to pay elsewhere or willingness to pay elsewhere, this is all within kind of a continuous primary account relationship that you have with Chime. And so you kind of overlay that primary account relationship with a history and likeliness that you're going to continue to use these products. That allows us to do more and more over time and kind of generates that flywheel where you show that history, you show that value. And, when you're at Chime, you actually have the unique ability to get more benefits from a liquidity perspective than you could anywhere else.
Got it. And how do you iterate on that? Because it seems like a very complex system. It's not like my scoring system for my initial underwriting. I have a model, I have some statistical metric, and then I say this looks better than the previous one, and then maybe I A/B test it for a quarter or so. But the system is much more complex, and the graduation time from initial $20 to I get a large loan is very long. So can you speak a bit about how to roll out changes safely and then be convinced that what you're doing works?
Yeah, I don't think it's that different than anything that you would typically see at a champion challenger sort of test where, every single time you want to push the envelope a little bit more, see if you can offer a little bit more that, from a risk perspective, maybe kind of in the look more iffy territory, but you believe it's the right thing. And if this works, it can mean significant benefits across your portfolio, particularly for the member base who, wouldn't actually have access to this kind of credit. And so, if you are able to do that and test it systematically, you can figure out, okay, how much can I increase based on the prior history? How much can I not? And then you can kind of evolve that policy over time. To your point, it's not like a simple like A/B test where a point in time like influences what you need to do over time. It's like a series of tests based on a variety of tenure and experience and all of that that make it much more complex. But at the heart of it, I do think it's still like a champion challenger test where you're trying to figure out how you can push the envelope in terms of what you can offer somebody.
How do you think about innovation there in the system? So obviously, AI does change our ability to look at certain kinds of data. What are you seeing right now in terms of immediate benefits? And maybe also, what's your vision for the next 2 years or so in terms of how that system will evolve?
On the immediate side, I think there are two things that it's done incredibly well. One is that typically what you see in certain functions is that okay, the credit risk team does one thing, the data science team does another, okay, then the strategic finance team wants another variation of this, but the product team believes this, and everything is like fairly siloed, and the level of decision making is all difficult to coordinate as a result. So the first thing that AI does really effectively is it helps break down a lot of these silos. Everything can move a little bit faster. Everybody can take kind of the same data set and work around it without having the same level of technical, familiarity and ease. And there's just a quicker jump from here's like the complex data set to here's actually the kind of the insight around that. So that's the first piece that helps everybody kind of, have the same conversation, right? It's no longer like, okay, I only can distill this information from this function, and then I have to work with the distilled information. Now everybody kind of has like access to the full picture and can, the same way that you historically query something, now you're essentially prompting something and getting that information too. And so that is the thing that is very, very helpful.
So basically, you have a system where AI generates SQL queries on your warehouse and replaces the whole BI loop. That's the use case you're talking about here.
Essentially, it allows you to, like, have more people access the same level of
Yeah.
information. The second part that is pretty powerful is, traditionally when you're trying to work as a risk analyst, you have this, set of data that is really hard to mine and understand exactly what's significant here. You can, like, plug a lot of that, function in, let AI kind of quickly, summarize and try to bring the pieces together. Then as a human, layer on your judgment in terms of what actually is significant or not. Obviously, it all has to work and be compliant and everything like that. But you essentially create like a risk analyst in a box, where you can much more quickly take data sets that you're not sure how much you should be spending time on, and then glean insights and figure out, okay, this is actually has the potential to slope risk. Let's dig more here rather than start from scratch. And I think that greatly accelerates the process as well.
Makes sense. And then do you have any use cases? We see a lot of traction for document-related use cases, but of course, that tends to be more of an SMB thing, or it tends to be a topic that comes up outside of the US as well, a lot where the infrastructure is slightly different. Do you have any use cases where you worked on document intelligence at Chime?
We have less of that. I do think like the traditional killer AI use case is like how can you automate more from a servicing perspective, and we see a lot of that in our support organization where you can quickly like get better transcriptions to calls and operate smarter and get insights much faster. So that part helps on the support side. For the underwriting side, What we've traditionally done has also already been pretty software based. It hasn't really required like document verification the same way that a mortgage has, and so that part hasn't changed that much. We kind of have humans in the loop only for the places where that require a lot of judgment, not like on an individual decision basis.
Got it. And is there a use case that's manual today where you think that'll go to 100% automation in 3 years, or maybe even in 9 months? I guess 3 years is hard to predict with the speed of progress at this point, but say 6 to 9 months. Is there a process where it's basically zero automation today and 100% in 9 months?
I think that the big unlock coming very shortly is this idea of like how can you get a policy to production as quickly as possible that makes compliance and innovation work at the same speed. You can talk to a lot of folks today, but the building of the model, the designing of the credit policy is one thing, and then going through the governance and the oversight and making sure everything works and is compliant, goes through model validation. That's the part that actually takes a long time. You're trying to get explanation of all the features that you use. And, if you decide that you're going to use more than 30, then you're like, okay, every single one I'm going to have to create more documentation around and explain more about. But one of the things I think AI can do is that, you can actually design a model based on how you think it actually should work and then automate more of the process around the governance process so that, it's less tedious work in between, but more of a direct conversation between risk and compliance, where you can quickly assess how well this stuff works and not worry so much about like the documentation and the processes, but focus more on like what is the actual purpose and what we're actually trying to do. And so I think that part can really go from, what is relatively manual today and requires a lot more work from the model builders to something that I think can actually make it so that you can have a conversation in near real time right after you complete something.
Yeah, I like this a lot. It reminds me of all the work people do in medicine around transcribing the patient-doctor conversation, and then doing all the admin for the doctors of filling in all the things that they have to fill in, which is super valuable time. So have the model builders spend more time building models and less time documenting what they've built. That sounds pretty good. Um, cool. Last question. So, if you can choose, or if you can dream, what's a dream tool that you'd love to have for optimizing your work, and especially the work between risk, engineering, and product, which is where you play?
Yeah, I think that it's very similar to trying to figure out this, I think, policy to production, but maybe one step further. We talked a little bit about the interaction between credit risk and compliance and how that's one important relationship. But there's so many more in terms of the overall process that we really haven't uncovered yet. And I think that AI can like basically shortcut all these decisions that are like very, very manual today. So I saw this interview recently with Sam Altman. He was just talking about how like a tool like Slack is a hard collaboration tool because sometimes it requires and creates a lot of fake work because essentially like people have to do certain things, respond to certain messages, and the signal to noise ratio is not what you want it to be. And I think the same goes into ultimately creating like an effective liquidity product. And it's everything from, what should we do from marketing side that we talked about at the beginning to how does the credit risk team feels about it to how can we make sure that humans are in the loop and, have the right layer of judgment accordingly and they understand what this is. And I think if you can kind of shortcut and combine a lot of those aspects, you can create something that is really effective, where you no longer have to worry about these kinds of debates from like, okay, is this the right LTV in the short term between marketing and risk? You're talking about the same language and similar between risk and compliance. You don't have to worry about generating all of these artifacts to kind of prove some of the compliance pieces. Like you're actually having a model help you do that and AI help you do that. And so that I think is really important. And then if you can kind of tie all those things together, you can really increase the pace of how quickly you can create new ideas in this space, I think, which is the most effective thing. Because as you mentioned earlier, like kind of creating a policy that can span and get better over time, that takes a lot of effort and it's really complex. And I think the real way that you can win this space is if you can kind of make the important work be the thing that you focus on, and all of the rest of the work that like checks the boxes in a lot of ways, a lot easier to do. And I think that's ultimately like what we're trying to solve here.
I love it. And this is very similar to what we see elsewhere too around really make these humans focus on the hard human stuff and less on the tedious stuff that's actually quite boring and repetitive. So let's automate that away first, and then we can do higher value stuff. Sounds very fun, and sounds like a really fun world to live in.
Hopefully we'll be there soon.
Yes. Thanks, Baishi. Thanks for joining us on Hands on AI. To find out more about the future of risk, follow me on LinkedIn under Maximilian Eber. And to learn about how Taktile is powering AI adoption in financial services, go to taktile.com. That's taktile.com.